Let's talk about the concept of short-term financing. Now, every business needs a certain number of assets or certain amount of assets to run the business. But this amount changes over time. And so the question is what's the best way to deal with the fluctuations in asset requirements? Okay? Because over time, firms have different asset requirements. So over the course of a year, for example, seasonal factors may require that they increase their total assets at certain times of the year, and at other times of the year, they can decrease them. And think about a company like Toys R Us. Toys R Us is going to stockpile a great deal of inventory during the holiday season when people are going out and shopping for Christmas and Hanukkah and buying a lot of presents. If you happen to be a company that's into making cement, well, during the winter, not as much building goes on, but during the spring, the fall, and the summer, a lot of building goes on. So they probably have to increase their inventories, the inputs that are required to make cement. So during the times, how are we going to finance these? So let's take a look at a picture here. If we take a look at a picture here, we can see that the asset requirements change over time. That's this fluctuation here. And these are due to seasonal factors. And so this total distance, okay, going up to this curve here, is our total asset requirement. However, our general growth in fixed assets and permanent current assets, we're going to assume grows on a consistent path here. So there's going to be a shortfall. That is, we're going to, at some points, need more assets than our current fixed assets and permanent current assets are. And at some points, we'll have just the right amount. So what kind of policy should we set up to deal with this problem? Well, the first thing we should do is define what these things are. Permanent current assets are the level of current assets the company retains regardless of any seasonality in sales. So they may keep a certain amount of money in the bank, they may keep a certain minimum amount of inventories, etc. The temporary current assets are additional current assets added when sales are expected to increase on a seasonal basis. As I said, Toys R Us, for example, is going to increase the inventory they're holding during the holiday season. They don't want people coming into their stores and not being able to find the toys they want and going elsewhere. So there are a couple of kinds of policies that a company can follow. They can follow a flexible policy, in which case what they do is they make sure their long-term financing includes the maximum amount of total assets they need. So this blue line up here is their total amount of assets, although this curve here represents the asset requirement. So you can see that at times they have exactly the right amount of total assets, so they do not need to borrow any money. But at times they have more total assets than they actually need, and in this case, those extra funds are going to be placed in marketable securities, things like treasury bills. Okay, short-term securities that can be easily converted into cash, but may earn some interest. So they're never going to have a shortfall here. They're always going to have sufficient funds. They don't need to worry about setting up a line of credit or borrowing any money. A restrictive policy is the case where what the company does is they finance, or their long-term financing only covers the minimum amount of total assets that they need. So there's going to be a shortfall at times because, again, this curve represents the requirement and this blue line here represents how much they have in long-term financing. So in this case, they're going to need to borrow money. There's going to be shortfalls here, here, and here. And what are they going to do? Well, they may set up a line of credit at the bank so that they can borrow when they need to. Okay? You find farmers do this too. At the beginning of the season, what do they need? They don't have any revenues, so they need to finance their purchase of seeds, of fertilizer to pay for the farm help and stuff. And so they do a lot of short-term financing. Again, Toys R Us could do it this way, where they borrow money during the holiday season to up their inventories, but during other times of the year, they don't need to do that, okay, because their long-term financing covers their needs. So this is one of those things that you need to think about. What's the best way to do this? Well, it depends. It depends essentially on the cost of long-term financing and the cost of short-term financing. If it's very inexpensive to raise funds long-term, then perhaps it's better off if you use a flexible policy, that you raise as much money as you'll need and you don't have to worry about the short-term financing. If long-term financing costs are quite high and short-term financing costs are more reasonable, it may be better to have a more restrictive policy and just borrow the money when you need it. The problem with a policy like this is that short-term financing can dry up. And you may have heard on the news or during business reports during the financial crisis in 2008 and 2009, and even several years later, a lot of small businesses had trouble borrowing short-term. These were not fly-by-night companies that had no collateral. These were companies that had a relationship with their bank for many, many years, never made a payment late, and they used a more restrictive type policy, and they borrowed money short-term to finance their inventories or to finance the seasonal fluctuations, and they weren't able to get a loan from the bank. Their line of credit dried up. So in that case, they would have been better off had they had a more flexible policy and had lots of money sitting in the bank. Okay. Choosing the best policy? Well, you need to consider cash reserves, maturity hedging, relative interest rates, that is, short-term versus long-term interest rates. A good compromise policy is to borrow short-term to meet peak needs and maintain a cash reserve for emergencies. And that might look something like this. Okay, here we have the restrictive policy where you only finance sort of the minimum amount of assets that you need. The flexible policy where you finance any amount of money that you'll need. And the compromise policy where you're sort of in between. So there are going to be times when you have excess reserves, and then you're going to, right here, you can put it into marketable securities. Right here, you're going to have a shortfall because of seasonal variation, and here you're going to borrow short term. So this is perhaps a more reasonable policy. You don't need to borrow quite as much. You've got a little cash on hand when you need it, but you're splitting the difference essentially. You're trying to keep enough money around so that you don't have to go to the bank too often, but not so much on hand that you have a great deal of money tied up in marketable securities.